In the spring of 1720, Isaac Newton looked at the South Sea Company, decided it was going to end badly, and sold most of his holding at a substantial profit. He had read the market correctly. He had, by any measure, won. Then the price kept climbing without him. And later that year, close to the very top, Isaac Newton bought back in and converted other holdings into South Sea stock as well. The best modern reconstruction of his accounts, by the mathematician Andrew Odlyzko, puts his losses at somewhere above £20,000. On his worst purchases, he lost as much as 77%. He was not ruined. This matters, and most retellings get it wrong. Newton had been a careful, diversified investor for decades, and he died 7 years later, leaving an estate of around £30,000. He remained a wealthy man. What he lost was not his fortune. What he lost was the argument he had already won with himself. Because the smartest man in England did not misjudge the South Sea Company through any failure of mathematics. He bought during a specific, identifiable repeating phase of a financial bubble. It has a name. It is stage 3 of 5. And every major financial collapse of the last 400 years, every single one, has moved through the same 5 stages, in the same order. This is the anatomy. Once you can see it, you cannot unsee it. The framework comes from 2 economists. Hyman Minsky, an American who spent most of his career being politely ignored, argued that stability itself is what creates instability, that the longer a system goes without a crisis, the more risk it quietly accumulates. Charles Kindleberger took that idea and ran it through 4 centuries of financial history. What he found was a sequence: displacement, boom, euphoria, distress, panic. 5 stages: Tulips in Holland, the South Sea in London, railways in Britain, Florida land, Wall Street in 1929, Japan in 1989, the Internet in 2000, American housing in 2008. Different assets, different centuries, different technologies, same 5 stages, in the same order, every time. And there is one more thing they share: a sentence. Spoken in Dutch in 1637, in English in 1720, in American in 1929, and in every language with a stock exchange since. This time it's different. Hold on to that. Because by the end of this, you are going to understand something uncomfortable about it. They were not stupid for saying it. They had evidence. Every bubble begins with something real. This is the part people get wrong. We tell ourselves bubbles are built on lies, on frauds and fantasies, and things that were obviously worthless. They almost never are. A displacement is a genuine change in the world. A new technology, a new trade route, a new financial instrument, a war ending, an interest rate collapsing, something that legitimately alters what an asset is worth and legitimately makes some people rich. In the 1840s, it was the railway. Britain was not wrong that railways would transform the economy. They did. The country built a network in 20 years that still carries passengers today. In the 1920s, it was electrification, the automobile, the radio, and the household consumer economy. America was not wrong about any of them. In the 1990s, it was the Internet. Nobody who predicted the Internet would restructure global commerce was mistaken. They were right. They were more right than they knew. And this is the trap. The displacement is not the error. The displacement is the truth that the error will later hide behind. Because when the crash comes, and it always comes, the people who lost everything will say, "But the technology was real," and they will be correct. The railways were real. The Internet was real. The houses were real, and people did live in them. Being right about the future is not the same as being right about the price. That distinction is where fortunes die. And at stage 1, almost nobody can see it. Because at stage 1, the people buying are usually the ones who understand the technology best. Stage 1 is not a warning sign. Stage 1 is good news. That is precisely what makes it dangerous. Stage 2 is when the money arrives, and critically, when the borrowed money arrives. A displacement on its own produces a rally. A displacement plus credit produces a bubble. Every time. In the 1920s, American investors could buy stock on margin at 10% down. Put up $100, control $1,000 of shares. If the market rose 10%, you doubled your money. The mathematics were seductive and, for several years, entirely correct. In the 1840s railway mania, investors did not even need the cash. Shares were sold on a deposit, with the balance called later. You could commit to sums vastly beyond anything you actually possessed, on the assumption you would sell before the call came due. In the 2000s, it was mortgages issued with no verified income, packaged into securities, rated as safe, and leveraged by institutions at ratios of 30 to 1 and beyond. Here is what matters about Stage 2, and it is the thing that makes bubbles so difficult to escape. At Stage 2, the buyers are right. Prices go up. The people who bought early make money. The people who borrowed to buy early make an enormous amount of money. The skeptics who stayed out watch their neighbors, their colleagues, and their brothers-in-law grow wealthy while they do not. Stage 2 can last for years. It lasted 5 years in the 1920s. It lasted the better part of a decade in the American housing market. And every year it continues, the cost of being cautious compounds, not in money, but in credibility. The people warning about risk are steadily discredited by the simple fact that they keep being wrong. By the end of Stage 2, caution has been thoroughly punished, and the market has quietly taught everyone in it that the way to make money is to stop being careful. That lesson is the fuel for Stage 3. Stage 3 is the Newton stage. This is when the character of the market changes, not the price, the participants. In Stage 2, the buyers are people with a reason. Insiders, specialists. People who understand the asset. In Stage 3, the buyers are people whose only reason is that the price went up. The tell is always the same, and it is remarkably consistent across 4 centuries. The arrival of people who have never bought this asset before, and who cannot tell you what it is worth, only what it did last year. In 1720 London, the South Sea boom spawned dozens of imitator companies, floated on almost nothing. In 1929, the market was full of first-time investors buying on tips. In 1999, day trading became a household occupation. In 2005, house flipping became one. There is a second, subtler symptom, and it is the one to watch for. At Stage 3, the standard measures of value stop being used and are replaced, not ignored. Replaced, someone builds a new metric and it catches on, because the old metric now says the asset is expensive and nobody wants to hear that. In 1999, companies with no profits were valued on page views and registered users, because profit was a metric of the old economy. In the 1920s, it was argued that America had reached a permanently high plateau of prosperity, so historical price ratios no longer applied. In 2006, national house prices had never fallen year on year in the modern era, so models were built assuming they could not. This is the mechanical form of "this time it's different." Not a boast, an accounting decision. And this is where Newton bought. He was not ignorant. He had already read the market correctly once and taken his profit. What broke him was watching other people be rewarded, month after month, for the decision he had refused to make. Stage 3 is not driven by greed exactly. It is driven by something more corrosive. The unbearable experience of being right too early, in public, while everyone around you gets rich. Almost nobody survives that for long. Newton didn't. Stage 4 is the quietest stage, and it is the one almost nobody notices while it is happening. The insiders begin to leave, not in a panic. Carefully, gradually, and into strength, selling into the enthusiasm of the people arriving at Stage 3. The directors of the South Sea Company sold while the price was still climbing. In the summer of 2007, 2 hedge funds, run by one of Wall Street's oldest investment banks, collapsed on mortgage exposure, more than a year before the crisis was publicly acknowledged. Here is the mechanic that makes Stage 4 so treacherous. The price does not have to fall. It can keep rising. It very often does. Because the selling of the informed is being absorbed by the buying of the uninformed, and there are far more of the latter, which means that at the exact moment the risk is transferring from the people who understand it to the people who do not, the chart is still going up. The chart is the last thing to know. By the end of Stage 4, the asset is held overwhelmingly by the least informed, most leveraged, most recently arrived participants in the market. The structure is now brittle in a way that no price on any screen reflects. It does not need much to break it. And here is the single most misunderstood fact in financial history. The trigger is almost always trivial. In 1637, the Dutch tulip trade broke at an auction in Haarlem, where for the first time, no buyer bid. That was it. No war, no plague, no policy. A room where nobody raised a hand. In 1929, one of the significant precipitating shocks came from London. The collapse of a business empire built by a financier named Clarence Hattrey, undone by fraud. A British scandal, an ocean away. Trivial events. Genuinely trivial. And that is the point. The trigger does not cause the collapse, it reveals it. By stage 5, the collapse has already happened structurally. It happened during stage 4, silently, when the asset moved into the weakest hands. The trigger is simply the moment the market is forced to look. This is why post-crash investigations are so often unsatisfying. Everyone wants to find the cause. They find a bank failure, a fraud, a bad auction, something far too small to explain the devastation that followed. And they conclude that the response was irrational. It wasn't. The system was already broken. The trigger just switched the lights on. Stage 5 is not the disaster. Stage 5 is the invoice. So, 5 stages. A real change in the world. Credit that amplifies it. A crowd that arrives late and rewrites the measuring stick. Insiders who leave quietly. And a small event that reveals what has already happened. Now, that sentence. This time it's different. We use it as a punchline, 4 of the most expensive words in the English language, and so on. But that framing is lazy, and it lets us off the hook. Because here is the uncomfortable part. They were right, every time. The railways really were different. They are still running. The internet really was different. You are using it now. Electrification, the automobile, containerized shipping. Every one of those displacements permanently changed the world, exactly as the enthusiasts promised. The people who said, "This time it's different," were not wrong about the technology. They were wrong about one thing only. They believed that because the asset was new, human behavior around it would be new too. It never is. The technology changes every time. The 5 stages have not changed since Haarlem. Which brings us unavoidably to now. I am not going to tell you what the market is going to do. Nobody who tells you that is worth listening to, and this channel is a history channel, not a forecast. But I will give you the readings, because you can locate yourself on the map. As of the middle of this year, the cyclically adjusted price-to-earnings ratio of the American stock market, the Shiller measure, which compares prices to a decade of inflation-adjusted earnings, sits at roughly 41. Its long-run median is around 17. The only time in more than a century of data it has been meaningfully higher was at the peak of the dot-com bubble. Concentration is at levels not seen in half a century. The 5 largest companies account for around 30% of the index. And in surveys of professional fund managers, a majority now describe the leading technology trade as a bubble, while continuing to hold it. Stage 1 is unmistakable, and it is real. The technology works. That is not in dispute, and if the last 400 years teach anything, it is that the displacement being real proves nothing at all. Stage 2 is visible in the capital flows. Whether we are in stage 3, whether the measuring stick has been quietly replaced, is a judgment, and it is yours to make, not mine. Stage 4, by definition, you cannot see from the outside. You only ever see it afterwards, and stage 5 needs nothing more than a room where nobody raises a hand. That is the anatomy. Every episode of this series is one body on the table. We are going to work through them in order, from the beginning, and we are going to keep a running total. Every fortune destroyed, adjusted into today's money, carried forward from episode to episode. By the end, you will have a number. It will be larger than you expect. Right now, the ledger stands at 0. We open it in Haarlem in the winter of 1637 with a flower, and with a story you have almost certainly been told wrong. The full ledger, established 1637.